It's the last trading day of April, and traders at UBA say they expect investors to stay largely risk-off on bonds in general next week, with some cherry-picking at yields as yields cross historical support levels. I have Dumebi Udegbunam. He's a fixed income trader at UBA. He joins me now for this discussion. Thank you so much. Let's first start with your outlook before we get into how we saw this week play out.
Good afternoon, Kenneth. So like I said, or like you earlier mentioned, reason being why we might be risk off is because of why we're seeing an upward tick in yields. As I earlier said last week to this week, we're seeing yields go as high as 2019, 2018 levels, trending towards, as of today, we're seeing yields as high as 14 levels at the 2050, 2049 bonds. So you expect traders to be a big risk of, reason being there's still momentum, or there's still an avenue for yields to go higher. If you saw what happened in the auction, in the April auction, where they move rates to the long end was about 13.85. So we foresee that breaking the current support. We foresee that breaking the current level where it is at right now to go even higher. So you don't want to hold positions at the lowest point of the yield curve. You want to be more risk adverse on that and emphasize on higher yields and then enter the market at those levels.
Right, but looking back though, how the week performed, even going far back as how to the month of April performed so far, what would you say has been the driving force in the markets?
Okay, so if I could give you a general overview of how the month is, I would just put it in two words: illiquidity and a supply issue. So for the month of April, we've had an illiquidity issue. This is the most times we've seen the system liquidity in the repo in over 6 months. As a month, the system liquidity was in about a negative 200 billion, but by when we had FAC payments coming, we saw system liquidity up to there about 400 billion. But the whole month we've been faced with illiquidity, and then a supply issue. So if you look at the OMO maturities or the OMO mop-ups by the CBN, we've seen a drop. If you look at a trend from where we're coming from in March, we had 100 billion, which further reduced to 90 billion, 40 billion, and 60 billion. In the month of April, we are far-fetched from that. We're seeing maturities only 20 billion, the highest we've seen so far. The lowest we had in maturities mopped up in April was just only 12 billion, compared to where we're coming from Q1, where we were seeing over 400 billion in maturities being mopped up or being supplied by the CBN. So those two things more or less made a very calm, quiet trading atmosphere in the market, with more or less bearish sentiments, and market participants continued to sell to create liquidity to take care of their obligations. So two things rule the market: illiquidity and supply.
All right, now tracking back, because when I remember the first T-bill auction of this year, I know it kind of printed the one-year instrument came up about 1.5% thereabout. But looking at the last auction though, looking at the levels we're seeing at the last auction, what has really changed so much?
So we've seen a tremendous increase in rates from that last time. Right now we're at 9.75. That's where the last auction closed, which is a clear sign of where we're seeing rates to go, and upward tick in rates going forward. Even the general view of the market, due to as we gradually exit the pandemic or a global recession, we're seeing an uptick in yields in the general view of the market, and Nigeria, one of the top emerging markets, isn't left out. So our one-year treasury bills right now is at 9.75%, which with fundamentals showing that the rates might possibly also go up further.
Okay, because when you now look back at what's played out in the international scene, though, talking about the U.S. Fed decision of leaving rates unchanged, how do you think that's going to impact the countries like Nigeria?
So Nigeria is faced with a peculiar issue. So in the U.S. market, the Fed, the reason why they're leaving rates unchanged because of why they're focused on two things: economic growth and unemployment. If you see right now, due to the stimulus package passed out and the infrastructure 2.3 trillion, we're seeing a lot of money being injected into the system, and they want to leave rates high, or want to leave rates to more or less cover up the unemployment, not really focusing on inflation. In Nigeria, we're faced with, well, should I say, the reverse is the case. We have high inflation, not really so good economic fundamentals. Our GDP growth rates from a negative 6.2 before negative 3.2 right now is just a positive 0.1, which is a fire cry for what we're coming from in 2019. 2019 we had a growth rate of 1.8 and 2.8% in consecutive quarters. So we are faced with a very different scenario, but an uptick in use in developed markets more or less spawns into the emerging markets, and we might more or less have a tepid tantrum where we might see a sell-off in the yields, in the US yields, which might cause a further increase in yields here. But in Nigeria here, our situation is different. Our economic indicators are not so good. So an uptick in yields is not really good for a market for a country that has a high inflation and a high unemployment rate and also low GDP fundamentals.
But before I let you run off and enjoy the rest of your weekend, in one word, what's your outlook for liquidity next week?
So for next week, for next month rather, because by next week is the beginning of a new month, we only have about 470 billion maturing into the system, no coupon payment, so we might still be faced with the same illiquidity issue as the NNPC released concerning the FAC payments, where there might be a reduction in disbursements to different states. So we might be still faced with this illiquidity issue, but we're hopeful because in the month of May we're going to have an MPC meeting where we might see the MPC try and do something to attack the situation and see how we can better hold a formidable market.
All right, and thank you so much. And thank you so much for your time. Dumebi Udegbunam, there is a fixed income trader at UBA.